I'm not retired yet, but here's why I choose dividend investing for my retirement strategy and why I prefer it over growth investing. And here's my take on trying to be funny before I put the turkey into the oven. When I think about growth investing and growth companies, they are hot, they're sexy, they're trendy, and get all of the hype in the media and online. Growth stocks are still in their wild phase of life. They're experimenting and they're not stable. Basically inconsistent. Sometimes they have a good quarter, and then for the rest of the year, they are burning cash. They're pretty on the outside, but absolutely crazy in the inside. On the other hand, when I think about dividend investing, they're husband material. They do their household chores, they're in touch with their emotions, they don't smoke, and they're mature enough to give back to those that love them. When I think about this type of person, they're predictable and they're reliable. They may not look pretty on the outside, and oftentimes, yeah, they might have a boring business model, yet it's effective. So here is reason number one why I prefer dividend investing over growth. Many of us are investing so we can live off our investments when we get older, alongside with our social security payments if that program is still around in the future, which for my generation is going to be up in the air. Anyways, we want to live off the land and enjoy the fruits of our labor. When your dividend portfolio reaches your milestone number like $600,000 with a 4.5% dividend yield, that gives you $27,000 a year in dividends. And when you reach that point, that can be the end of adding more money into the account. But if we just look at history, which by the way, I started to listen to Hardcore History by Dan Carlin, phenomenal podcast. History shows us that the market returns at least 8% year after year on average. In other words, no matter what happens to your 10,000 shares of Coca-Cola in the day-to-day, you will still yield $27,000 in dividends a year, and that will get bigger and bigger with a 4.5% dividend growth rate. Let me show you what I'm talking about. Alright, so let's go ahead and assume that you had invested in the stock market for over 30 years, and on year 31, you finally reached your milestone of $600,000. And some assumptions that we are going to make, your portfolio will grow 5% year over year, and you will not reinvest your dividends. So on year 31, with a dividend yield of 4.5%, that payout is $27,000. And with an average dividend growth rate of 4.55%, that means your dividend payout is increased by $1,200, which means your annual dividend payout is going to be $28,000. As your portfolio grows in value from time in the market, look what happens to the annual dividend payout because of the growth rate of the dividends. And when you look at year 43 in your retirement, from that same portfolio of $600,000 and not putting a penny back into it, you will get essentially $46,000 in dividends. But remember, the dividends are growing year over year. It's going to be $48,000 a year. Whenever you watch a video or read an article and they refer to the compounding effect of the market, this is essentially what they are referring to. Time in the market just allows your money to amplify beyond belief. And the thing is, when you retire at year 30, if you don't necessarily need all of those dividends and you go ahead and reinvest some of it back into your portfolio, this model right here will be modified and your portfolio will be even bigger. So this is a hypothetical situation in a perfect world where there are no dividend cuts, where the market is consistently bringing at least 5%, which is really conservative. But let's go ahead and look at a real example of what happens during an economic downturn if you invest in a high quality dividend paying company. Domino's Pizza, ticker symbol DPZ, average dividend growth rate of 10%. The dividend yield is roughly 1%. The payout ratio is 33%. Even during the pandemic, Domino's paid dividends and even increased their dividend payout. So when we think about the hypotheticals, with a high quality company, you will still be able to live off the land and enjoy the fruits of your labor. There shouldn't be fear and uncertainty that they will cut the dividend if you heed the advice from my dividend investing strategy video and choose companies with the right traits. So as you can see from the Domino's example, you get dividends despite the external market conditions. And so that's reason number two as to why I prefer dividend investing. When you invest in high quality dividend companies, the best part is you can choose to do whatever you want with those dividends. You can withdraw the dividends to pay for a car or reinvest those dividends back into the account known as DRIP. With dividend investing, you don't have to touch the amount of shares you have in order to withdraw cash from your portfolio. I love this because it gives you the option of passing down your investment portfolio of 10,000 Coca-Cola shares after you leave this world. And it gives you the option of, if it starts raining beyond belief and you run into bad luck and obstacles during your retirement, you can sell a portion of your portfolio in order to get extra cash. With a growth portfolio, you are defaulted to the action of selling shares in order to withdraw cash, which takes me to my next point. If you do growth investing with the plan of selling a portion of your portfolio to pay the bills, that portfolio is going to be at the mercy of the market conditions. For reference, some growth investors sell 4 to maybe 6% of their portfolio a year. Let me show you an example. So this example is going to be in the same time horizon as the first example. So with a growth portfolio, this is what retirement might look like. And some assumptions that I am making is that there is going to be an 8% rate of return year over year, and every year you're going to withdraw 5% in order to pay for the bills and to enjoy your retirement. So after working and investing for over 30 years, on year 31, you finally hit your milestone of $600,000. And so at the end of that first year, you're going to withdraw $32,400 from your portfolio. Your portfolio is now going to be valued at $615,600. And when you fast forward throughout the years and repeat the same cycle and assumptions of an 8% rate of return, on year 43, your 5% withdrawal will now be $44,000, and your portfolio will be valued at $837,000 after that withdrawal. So essentially, with a growth investment portfolio, you can think of your withdrawals, which is selling a portion of your portfolio to get that cash, as your dividends. So you create your own dividends. And so when we compare year 43 of a growth portfolio to the dividend example, on year 43, your portfolio, because you haven't been selling any shares, will now be worth $1 million with an annual dividend payout of $48,000. Jumping back to the growth example, you can sell a bigger portion of your portfolio in order to bridge the gap of what the dividend portfolio is giving you. However, that's going to have implications for the size of your portfolio if you choose to withdraw more than 5% a year. Clearly, the winner to me is the dividend portfolio, where you don't have to reinvest anything back into it once it hits your milestone number. And both of those examples were created in a perfect world of an 8% rate of return for the growth and 5% for the dividends. However, the catch is sometimes your portfolio will go up and sometimes it will go down. If you follow growth investing and this strategy, you'll have to sell and make withdrawals when the economy isn't doing too well. You're still going to have bills and you're still going to have to cover your living expenses. And because you have to sell when the economy isn't doing too well, this usually means selling certain shares of your portfolio at a loss, because you can't force the market to behave a specific way on the days that you want to sell. I don't like this because it's based on timing the market and for Lady Luck to be on your side. What if you choose to retire during a market downturn? What if things are phenomenal when you retire and then it goes quickly south? Like when you venture out to do an easy 4-mile jog in the morning and you get the sudden urge to go doo-doo a mile into your run. What happens? What happens when your portfolio's valuation goes from $600,000 to $450,000 in a matter of months? An example that I want to show is Snowflake, which is a cloud data storage company that is a growth darling. So let's say your growth portfolio had a ton of Snowflake shares. So let's say in the middle of 2021, you decided that you wanted to retire because you were feeling burned out at work. And as the year progressed and it transitioned into fall, you noticed that Snowflake was performing well and your portfolio was looking great because it was up by 38%. You were absolutely excited to submit your 2-week notice in November because your portfolio was now up by 56%. sense. And so for your last 2 weeks at work, you were developing post-retirement plans of going fishing all the time, playing with your grandchildren, picking up golfing again. And then eventually, you finally retired. You felt like a genius and your retirement plan seemed foolproof. Weeks into your retirement, your portfolio drops by 9%. And as the year progressed, your portfolio keeps dropping and dropping and dropping. And from its high back in November when you put in your 2 week notice, now it's down by 68%. And now you're living out your retirement stressed, emotional, and angry. And I know that example is pretty extreme because who is going to go all in on Snowflake unless you were an employee there and you had an employee stock purchase plan? Some of us do have that benefit for the place that we work at. So it's not an entirely out of this world example. But getting back on topic, with investing in high quality dividend companies with an economic advantage in their industry, those dividends are predictable and on time. I don't have to worry about the economy or if any stock in my portfolio trades up or down. I don't have to worry about timing the market or trying to sell any shares. I still get that dividend every 3 months or every month, depending on the company. Just like when I shave my face, I can expect my facial hair to grow back within 72 hours. Dividends are the birthday presents that arrive at the perfect time every time. But I don't want to come off too cynical and biased against growth stocks because not all is bad with growth stocks. I understand the appeal of growth stocks like Tesla or Amazon or Shopify. Their rate of return for the past 10 years is absolutely mind-boggling, and that alone is a reason you may want to consider growth investing. However, in general, growth stocks are more speculative and therefore riskier. Did you know some growth companies might not even be profitable at all and therefore couldn't pay dividends even if they wanted to? Some growth stocks have negative free cash flows, but their stock price reflects market expectations on their potential to be profitable in the future. This is inherently risky because they might actually never turn a profit. Kind of like if you're balding and you apply a magic cream on your head to get your hair back. It may or may not work. The cool thing about growth investing is this: you don't pay taxes on your share appreciation until you realize, which is when you sell your shares and lock in those gains. This can be strategic because you can take advantage of those long-term capital gains tax rates and sell in years when your income bracket is lower. This is not financial advice. Whereas with dividend investing, you'll be taxed unless your portfolio is a Roth IRA or your qualified dividends put you in the 0% tax category. The next reason why I prefer dividend investing is there is less emotional burden. Peter Lynch is probably one of the most successful mutual fund investors of all time, and he said this: "I've always said the key organ here isn't the brain, it's the stomach. When things start to decline, there are bad headlines in the papers and on television. Will you have the stomach for the market volatility and the broad-based pessimism that tends to come with it?" Sorry, that was my impression of Peter Lynch. Investing sounds fun and exciting on paper. However, once you start investing and you see your portfolio drop from $100,000 in valuation to $70,000, you're going to feel every single emotion in your heart. You're going to feel anger, fear, anxiety, and the urge to panic sell your investment in the high quality company that you once believed in. And when the emotions run that high, you'll even start reflecting on mistakes that you made in the 5th grade. Dividend growth investing is less demanding in terms of emotional discipline, and this is why I really like it. You don't have to calculate and act on exit points, and some investors don't even calculate entry points because they dollar cost average regardless of how the market behaves. Exit points is essentially your strategy of when you want to sell your shares to lock in those gains. As a dividend investor, you just let the dividends compound your positions, returning a fractional amount of value to you on autopilot without any work on your part. The market's tanking? That's okay. Your dividends are still flowing in if you invested in high quality companies with strong balance sheets and the economic engines to power through a down market. It's a lot easier to avoid panic selling when you're seeing cash still transferring into your brokerage account. The psychology behind seeing those dividend payments pour in while you wait for the stock market to go back up can be tremendous. And I am telling you, as somebody who lived and invested through 2020, those dividends at that time were better than the dinner rolls at Texas Roadhouse. house. This is not to say that dividend investors are somehow inferior to growth investors because they know how to calculate entry and exit points, or that dividend investors are weak compared to growth investors because they can't handle their emotions. Instead, it's about tailoring one's investment strategy to one's emotional profile as an investor. It's about not letting your financial life ruin your actual quality of life by piling on stress and putting you through sleepless nights. If you want a bad night's rest, then go ahead and watch a movie titled Hereditary at 10 p.m. by yourself. I double dog dare you. Or if you enjoy pain, I guess one can just invest in speculative growth companies. Either path will lead to a sleepless night. And so, another reason as to why I prefer dividend investing is that growth investing takes more skill. Growth takes art and science in order to execute well. A growth investor needs to know when to sell and lock in unrealized gains of their stocks. It's about understanding the fundamentals of the business and how much of a premium the stock should realistically command. When its share price begins to reflect a premium far beyond what is reasonable, in my opinion, that's the time to lock in those gains and shift that capital to other undervalued, high-quality dividend stocks. But hey, did you know that's not financial advice? Anyways, if your growth stocks never get above your exit point in terms of valuation and then crash like they did in 2022 or in 2020, you must have the discipline to write it out. You can't panic sell, you can't exit your positions at all. A growth investor needs to be stoic enough to sit on companies they truly believe in through the entirety of a bear market if they were not presented with a proper exit point prior to it. Even if the 10-year returns on a growth portfolio beats the 10-year returns on a dividend portfolio, the emotional experience of owning one versus the other can be drastically different, and some investors may not be able to reliably avoid selling at the wrong times. Others may not be able to convince themselves to sell at the right time because they have this fear that the stock is going to continue to defy gravity and fly higher and higher. With growth investing, exit points are much more important to the recipe. And I feel like a lot of new investors flock towards growth investing because they've only seen what happens to stocks during a bull market. When stocks are going up, of course you get FOMO and want to jump into the rocket ship ride to the moon. However, I'm going to try to sound elegant here. It is my opinion that more growth-oriented investors will gravitate towards the slow and steady strategy of dividend investing once they experience a recession or a dreadful bear market. Again, I'm not trying to insult dividend investors, but on Thursday, you wore mismatched socks to work, and I'm calling you out, Bob. I'm calling you out. The next reason why I like dividend investing is the fact a dividend portfolio builds wealth. So let's assume that you start out with $2,500 in your dividend portfolio and you contribute $1,500 every single month. By the end of a 25-year time horizon, your ending balance will be just shy of $2 million. I know that not everybody can afford to put away 70% of their paycheck into their dividend portfolio, and that's why earlier in this video, I used a conservative example of $600,000 after 30 years with a much smaller monthly contribution. And this is what I mean when I say a dividend portfolio builds wealth. If you don't sell any shares, this valuation is going to continue to go up, and the annual dividend payments are going to continue to go up as well. And something about me and why I tried so hard in school and at work, and why I'm so passionate about financial literacy is that I come from a low-income background where money was constantly an issue and the root of all arguments because we never had enough. I used to envy my friends who come from a background with generational wealth. You know, they have a lake house, they have a third house near a ski resort. That type of generational wealth. Somewhere down their family lineage, somebody planted seeds, and now their entire family is financially set. I do dividend investing because I believe in the statement of, if you want to become a great investor, invest for your grandchildren, not for yourself. With dividend investing, you pass on that passive income cash flow from yourself to your dedicated loved ones. You like getting those dividend payments from Keurig Dr. Pepper? Well, your grandchildren will appreciate them too. Hopefully, if they're not brats. And if they are brats, then pass it along to a nonprofit that you fully support. And it makes me sick to know some of us will perish within a few years of retiring in the future. So please do try to enjoy your life in the present tense and do not put off living life until you are too old. That's a recipe for regret. And that's not financial advice. That's just amigo to amigo talk. In the grand scheme of things, at least the seeds you plant today will provide shade for those in the future. And this quote slapped me across the face as if I was a philosopher. It goes like this: the one who plants trees, knowing that he will never sit in their shade, has at least started to understand the meaning of life. Life is more than just about you. One caveat that I want to point out is just because a company doesn't pay a dividend, it does not mean its total return will be better than a dividend-paying company. Sometimes a company can't afford to pay a dividend because they don't have excess cash on hand and they're struggling to stay afloat. And other times they do have the cash and decide to greenlight most reasonable projects to potentially grow the company. Google is infamous for taking their core ad business, which prints money by the way, and throwing it all down a hole every year by launching products and services that are discontinued immediately and never make a profit. On a side note, that's why I am always hesitant to fully integrate into a Google product because they're like Netflix. They're not afraid to just get rid of a show if it doesn't meet the numbers in a 12-month timeline. There is literally a website that is dedicated to showing all of the different products and services that Google decided to get rid of. But what really annoys me from seeing all of this is there are people that are dedicated and enjoy the actual product, and then one day it's going to be gone. For some of these, I absolutely understand because I'm guessing nobody was really using it. On a side note, if you work at Netflix, could you please bring back Marco Polo, Archive 81, and Cowboy Bebop? Please. I actually enjoy these shows and they just got canceled out of the blue. And before I get too far off track, obviously you want to buy companies that are growing and have a lot of room to continue growing. But it doesn't necessarily follow that you'll get a better return by investing in growth companies. That is, companies that do not pay dividends to try to focus on growth exclusively. I'm looking at Palantir, Lyft, Roblox, etc. The fact is that half or more of the stock market's total return has been from dividends, and growth stocks are historically underperformers as an asset class. Per the managing and executive directors of the JP Morgan Equity Group, they said this: dividends dominate the components of total return over the long term, while dividend-paying stocks have historically outperformed non-dividend-paying stocks. Just look on your left, the average annual return from 1972 to 2019 in S&P 500 for dividend-paying companies, 12.9% year over year. For those that do not pay a dividend, 8.6%. And maybe that's because the companies that do indeed grow the most probably don't have the biggest market cap and are not a part of the S&P 500. But regardless, let me get on my soapbox and convince myself that dividend investing is the best. If you look to your left, companies which paid a dividend and grew their dividend had an average year-over-year return of about 10% since 1973, whereas companies that did not pay a dividend returned about 4%. Hey, don't shoot the messenger, but that's the facts and data surrounding the S&P 500. And on your right, you can see the compound effect of the stock market with just $100. If you invested that $100 into dividend-growing companies, that would have been $13,000 in 2022. And with quote-unquote growth companies, that $100 would be $694. In regards to the S&P 500 and the biggest companies in the market, it does in fact look like the dividend-paying companies carry the market on their back. And circling back to Google, low-key, Google could be better off expanding their Pixel phone line, cloud storage, and ad business, and then giving dividends instead of greenlighting and canceling projects that cost billions of dollars each year. So freaking wasteful. Why not just give me a phone donation? Which, by the way, I am considering the Pixel phone, but I am leaning towards Samsung. I'm not really sure. And here's my last reason as to why I prefer dividend investing over growth investing. And it's all about the psychological effect of dividends. I alluded to it earlier, but if the market trades sideways for years on end, isn't it better to get dividend payments while it goes up and down? With a growth stock, it could trade for $100 in January and go up and down throughout the year and end up at $100 by December. With a dividend stock, if it does the same thing, at least you get dividends in between that salsa dancing routine. And not to mention the passive income side of things. Dividends pay you regardless of what you are doing in the present tense. If we only focus on our active income, what happens when we get fired? Or when our job is replaced by AI? Or if we are no longer able to work? Through dividend investing, it allows passive income to help you one day have FU money. Besides, remember the joy you felt when you went trick-or-treating as a wee lad and you would get a Reese's Pieces or a Snickers bar in your bag? Unless you were homeschooled and your mother was a tyrant and she never let you participate. Receiving dividends is the grown-up version of trick-or-treating. You can still feel that same excitement you did when you were young, full of hopes and dreams, only to learn the harsh reality of working 50 hours a week for the rest of your life at age 22. That's why we are all doing this investing thing, so we can clock out sooner than age 67. And here's a pro tip, it's not financial advice, but why not get the best of both worlds? Pick a growth company that also pays a dividend. A good place to start looking and researching are the top dogs in the S&P 500 index and seeing how they performed over the years, and then of course running some valuation models to figure out their intrinsic value. Whoops, I wasn't trying to advertise my channel. So here's the conclusion, and this is really important, so please listen up. Personally, I prefer dividend growth investing as the main and primary strategy of my portfolio. I prefer it over growth investing. Yet, I see the data and the numbers behind growth investing in the modern decade. So, I also invest in growth companies that don't pay a dividend like Meta. Obviously, when you look at the data that goes back to like 1970s, then of course growth investing looks bad. But if you look at growth investing since the era of the internet, then it's not so bad. And stocks like Meta, Google, and Tesla have just absolutely crushed the stock market. And so, what I'm trying to say is that neither option is wrong. It does not have to be a polarizing or mutually exclusive decision. Growth investing versus dividend investing is more a matter of personal investing strategy than one being empirically better than the other. It's like having a political opinion at the Thanksgiving dinner table. There's no wrong position depending on your beliefs, comfort level, and if you want the entire family to never invite you back. Jokes aside, if you enjoy this video, please do consider subscribing. It really helps a small-time YouTuber like me. And my final words on the topic, the most important thing is staying invested in the market, dividends or not. That's my opinion. With that said, dividend compounders with cheese, signing off. Stay safe.